We are talking about the Alpha Strategist note by the Motilal Oswal Private Wealth team. And the theme for this month's note is Goldilocks and the three bears. Now, I can understand that the Goldilocks scenario has to be about India's macro and how well we have entered into a period wherein a lot of stars are aligning for things to look better. The question or the inquisitiveness that I have is over the three bears. One of the bears might be valuations, but let me not try and probe this too much. Let me get in the men who've written this note to come in and talk about what the note is about and what's the outlook looking like. So Sandipan Roy, CIO of Motilal Oswal Private Wealth, as well as Nitin Shanbhag, Senior VP and Head of Investment Products at Motilal Oswal Private Wealth with us on the show. Gentlemen, both of you, good afternoon. Thanks so much for joining in. What brought about this title called Goldilocks and the Three Bears?
Yeah, it was interesting. We think that and we believe that India is at a Goldilocks phase, and we thought let's address from the fairy tale the three factors that actually or the three bears that are there, right? And we kind of zeroed down on the main bears, which is one obviously is valuations, which is a perennial concern for a growth economy like India. The next one was inflation, which obviously is a cog in the wheel in at all practical purposes for our economy. And then obviously the deficits, which also become a governing factor for the currency, right? So these being the three main factors, we thought let's address them head on and see how they fare and why we believe this is a Goldilocks economy.
Okay. So to that extent, we also saw the trend over the last 10 years, in the last decade and starting all the way from 2013 onwards, where if you remember, Niraj, we were actually being classified as a fragile economy. And all these three aspects really were down on the negative. And so that improvement has happened. Obviously, in the last 10 years, we've gone through all these phases that Sandipan just spoke about. And today, hence, we believe, and we'll obviously explore more of them as this show progresses.
See, since you spoke on the valuations, Niraj, you want us to address that part to start with?
Let's start with that because I was just thinking, it seems that one of the bears, valuations, we will never get away from it simply because the flow is so good. But the other two seem to be, in some sense, if things go well, might actually become very small bears with the time to come, Sandipan.
Yeah. So
let's start with valuations, sure.
Yeah. So on valuations, I think some interesting data points that we came across. I think Nifty, for example, has been on a re-rating on a trailing PE basis over its course of history, right? So we dug out some data that in FY07, the Nifty 10-year rolling trailing PE used to be only 14x. And since then, we have gone up. Today the trailing P average is about 22.5x. We'll be somewhere in the range of about 24. On a forward P basis, will be about 21.1 or so on an average of 20. And that has also got a lot to do with the fact that the index compositions themselves have changed. We have gotten a lot more growth-oriented stocks in the index, etc. So valuations stand alone would not make a real comparison. If we go back to history, we have to look at valuations with the growth that comes with it. And there, I think we are fairly poised. Our own estimates are about 13 to 14% EPS growth over the next 2 years, which puts it in good stead, at this moment. When the entire world is talking about slowing down, I think this becomes one of the only economies where you see that kind of earnings growth along with GDP growth and the macros, which are extremely healthy. So the PAT CAGRs over the last 3, 5, 10 years have been, was 25 to 80 and 18%. 25% is the last 3 years PAT CAGR itself, right? So, and GDP growth in any case, have been upwards of 6 to and always been around 6 to 7% for us. So with that as the premise, I think valuations, now we can also move to the mid-cap space. In the mid-cap space, Nitin?
Yeah, so we've been saying that the mid cap and small cap at an aggregate seem to have run up too much, and consequently, that's also reflecting in the valuations. In fact, both mid cap and small cap on the index level are trading at more than 2 standard deviations as per their long-term average. Having said that, the growth trajectory expected by the market in general is far higher than the large cap. So If we talk only Nifty, then the next 1 year we are expecting about close to 10 to 11%. The next year close to about 18% growth. Whereas in the mid cap, the average growth would be in the vicinity of anywhere between 20 to 22%. And for the small cap, it could be in the vicinity of maybe 16 to 18% on average. So clearly, the valuations cannot be looked at on a standalone basis. They have to be looked at from an earnings growth perspective. More importantly, Niraj, we also feel that the ROE profile, that has seriously improved for the entire aggregate category. Hence, if the quality of earnings is improving, then that should keep some kind of a support or some kind of a cushion as far as valuations is concerned. But having said that, mid and small caps, one definitely needs to be far more bottom up in terms of stock picking.
Yeah.
Actually, I was gonna come to that. Sorry, I'll just have a cross question there, Nitin. Right? People don't have a mid cap, a Nifty mid cap or a Nifty or a BSE small cap futures in their portfolio. So, and a lot of sectors which are promising larger profit pools and stronger growth over the course of the next, let's say, 3 to 5 years, don't necessarily fall in the Nifty 50 or even the top Nifty 100, right? So while this conversation around valuations in the mid cap and the small cap space are warranted, could portfolios still have high quality mid cap and small cap names as a larger proportion and still do well?
Absolutely. And this is a trend that we've been seeing over the last, 6 to 8 months. That while at a broader level, people may be cognizant of valuations, but there are a lot of opportunities. For example, chemicals as a space. A lot of stock opportunities out there may not necessarily be part of large cap. Similarly, all these new age sectors that are coming about, right? Whether it's to do with renewables, whether it's semiconductors, and all of these, none of these stocks are available in the top 100 space. So incrementally, when one is looking at structural growth stories, given the capex, given the manufacturing impetus that the government is also putting through, we believe that a lot of portfolios could continue to have some piece of mid caps and small caps in them, and hence, one feels that having a multi-cap approach rather than just saying that the mid cap and small cap at an aggregate is overvalued. One should not look at that space. One should tend to have a bias towards multi-cap and large cap, but do continue to invest in mid-cap and small cap strategies as well, albeit you need to stagger it out over the next 6 to 12 months.
Okay. Sandipan, the other point that you mentioned about the other two bears, one is valuations, but the other one is the deficits, right? Just trying to understand, with this whole rate cut cycle coming in and our macros looking the way they are, you reckon it will cease to be a problem area? In some sense, CAD probably already is, right?
Yeah. So that's what we wanted to, kind of bring out, that how, India has evolved over the last 10 years and how, the perennial deficit problems of ours have got addressed by this government and the central bank. And obviously, the macro tailwinds obviously help there. And hence, that ceases to be a problem child at this moment for sure. The CAD is controlled. The fiscal deficits are controlled. The budget is more is less inflationary and more expansionary, and that really helps. So these prudent norms, I guess, tames the bear, which is the deficits for us. And the third one, which is inflation, I think the joker in the pack has always been for us the oil prices. And with that being controlled, thanks to the global slowdown, China slowdown, and a huge unrest that is still unfolding in the Middle East, and yet there is no spike in the crude prices. Really, puts us in a very, very comfortable zone when it comes to the inflationary pressures.
Most certainly. In fact, that was going to be my question. Does to you guys, when you look at what's happening to commodities, right? Does oil seem to be in a structural lower range? I won't say a downtrend because who knows what the trend might, but does it seem structurally to be now in a lower range, and is that therefore a longer term positive for India? I mean, who can predict crude prices? They may go up, but for now, the hypothesis is that the hypothesis?
Yes, from the technical standpoint also, As also from a fundamental perspective, we feel that the prices would remain more or less tamed and range bound than going through a breakout anytime soon. It has seen the worst of things that could have happened, and yet we don't see the prices going up. A lot of it obviously has to go with the global demand or the lack of it, right? And with an impending recessionary pressure that is building up in US, China going through its own bout of slowdown. The Russia-Ukraine war obviously has its own dynamics that has given oil prices a different kind of control altogether. I think all these things have come together and then given us again a Goldilocks situation on oil prices, for us at least.
Okay, gentlemen, one last question. We have that much time, but I actually wanted to ask two, but there is a management waiting, so we'll have to squeeze it into one. I'm going to try and let you choose. One of the slides speaks about how sector rotation is going to be more visible going forward. And of course, we have a section on gold with gold prices having hit new highs yesterday. Any one which you think you want to lay more emphasis on before we wrap up?
We'll just put one on the gold. Gold, we have a price of about 2,800 on the dollar, which we have spoken about in the past, and we remain structurally bullish on gold.
Absolutely. Sector rotation. On sector rotation, we believe that it would continue to be heightened because a lot of sectors which had rallied over the last 6 months to 8 months, we believe some ownership is coming down out there purely on terms of valuations as well as order execution. That is something that will be visible. The private banks seem to be offering some kind of value. People do find some opportunities in pharma in the current context and maybe a smattering in terms of consumer durables. So to that extent, we believe sector rotation is here to stay and perhaps may even heighten given where the markets are as of today.
Yes.
Okay. Very interesting. Gentlemen, lovely note. Thanks so much for putting it together and for talking to our viewers about it. Much appreciate your time.